Earnings season continued this week on Yahoo Finance. We heard from some big names like UPS and Disney. The reports have been mixed as companies continue to deal with high interest rates and economic headwinds. Here's a recap of the results.
So we look at this UPS results. UPS tends to be seen as an economic bellwether. Is that still the case with all this sort of Teamsters noise? What can we take away from these numbers?
Yeah, Julie, I think it is a little bit concerning about what's going on with the consumer. I mean, yes, we have the situation where they blame most of it on this new contract, but on a macro basis, that's not all that great because we worry more about wage inflation and what does that mean for the Fed, and will they keep rates higher for longer, even if they're going to stop, or even if they've already stopped cutting rates. But on the consumer side of things, as you said, the demand was down, revenues are down. I mean, we can talk about their margins might get hurt because of the higher wages, but if revenues are down, revenues aren't impacted by wages, and that tells us that maybe the consumer is starting to pull in their hands. I mean, we saw some news out last week on the domestic travel side from JetBlue, and even though people are going overseas and they're spending time in restaurants and the experiences, they seem to be pulling their hands, pulling their horns in a little bit, and that does get me a little bit concerned, given how important the consumer is for our economy.
Matt, let's stay overseas for a hot second here, because when we think about that international impact that the company talked about in this quarter, saying that the revenue decreased 13%, primarily driven by a 6.6% reduction in average daily volume and continued softness on Asia trade lanes. How much longer do you think that could continue to be a headwind for this company?
Well, I mean, the problem we have is that the slowdown that we've seen in other parts of the world. I mean, Europe seems to be stabilizing, but Asia certainly not. And we have some more news, of course, out of China on their trade numbers that are very concerning, and that of course spills over to the rest of Asia. And with the again this whole idea that we've been harping on for most of this year, that people are spending less money on stuff and more money on experiences. Well, that's fine, but if the experiences are starting to pull back a little bit, and we've already have a problem with people buying material items, that again creates the kind of headwinds that we don't want to see in an economy here that is based 70% based on the U.S. consumer.
At the same time, how should we be thinking about the U.S. consumer? Because as you said, there has been this shift to services from stuff, and yet then you had Amazon, whose stuff is selling pretty well. So it feels like I don't know, it's a little murky right now.
Yeah, no question, Julie. It's not like we're looking at the consumer suddenly imploding, but we do have the. We're just getting a lot of mixed signals. Amazon's been pretty good, but you see what the retailers did in when they reported earnings last time. They have yet to report yet. We'll hear from them in the future here. But their stocks have obviously got pummeled real hard during the last earnings cycle, and of course their guidance wasn't very good either. Their stocks have bounced back a little bit, but that I think seems to be more technical in nature. And again, the concern is not so much that the consumer is going to implode, but it does start to soften with credit card debt at all-time highs and savings rate having come down from the level we saw at the pandemic. I mean, are they going to be strong enough to fuel further gains going forward?
Matt, you mentioned a moment ago how much UPS had kind of leaned into what the negotiations had been like with the Teamsters, how that played out, what that means for the guidance going forward here. Is there anything and this has been a big year for some larger union negotiations, is there anything that we can extrapolate from what UPS and their own negotiations look like and apply that to some of the other kind of employment situation and union negotiations that are still moving forward?
Well, there's no question we're seeing it. The unions and workers overall have more leverage than they used to have, and it's whether you see it in restaurants. We've been talking about it for a couple of years now. Well, now these union contracts, which obviously involve tens of thousands of people, are coming to a head. And look what happened with the pilots unions. You're getting 40% increases. Mm-hmm. These are very significant, and at some point it's going to have an impact on margins. And the biggest thing we keep talking about, we're going to be able to avoid a recession. That's great, but if earnings don't increase going forward, and with those margins being compressed, if earnings can't increase, that's going to again make it tougher for the stock market to rally as strongly as it has so far this year.
Well, Wendy's reporting earnings today, falling short of revenue estimates, but just beating profit expectations. Morningstar equity analyst Sean Dunlop was on the earnings call earlier today, and joins us now. We are seeing the shares under pressure right now in this session. What stood out to you, the big headline here coming out of the results today?
Yeah, what we're starting to see is a little bit more cautious of a U.S. restaurant consumer, and that's a concern that we've harbored for a little bit of time. So same-store sales grew 5.1% in the firm's home market. That suggested that it mostly maintained its share in the fast food category broadly, but did underperform both Burger King in the U.S., which had 8.3% comp, and McDonald's, which had 10.2% earlier in the quarter. So the reluctance of consumers to come into stores, traffic was a 1-point headwind, and then we see certain evidence of check management that certainly suggests to us that we're likely to see a bit more of a promotional environment moving forward, and maybe a little bit of difficulty driving durable comparable store sales growth over the rest of the year. That was probably our key takeaway.
Sean, what do you think of the pricing strategy here from Wendy's? Because they said that they're not going to be raising prices any further, at least for now. We heard from some of their competitors, like McDonald's, that they may begin to adjust some of their pricing to the downside here as inflation does ease in the second half. Does their pricing strategy up until this point, does it make sense?
I think it does. As you look at Wendy's core customer, they tend to skew a little bit less affluent than we see at some of the other chains. And they've obviously had a little bit more trouble attracting traffic, down 1% in the quarter relative to peers like McDonald's, who saw +4. So I think it makes sense to be very cautious, very cognizant of where the consumer is today. We saw the opposite example with Papa John's earnings, where they raised prices a little bit too aggressively, and where franchisees saw a negative 2.3% comp in the U.S. That's certainly something that restaurants need to keep an eye on in the current environment.
Yeah, so let's kind of broaden it out into the space sort of beyond Wendy's, because as you point out, consumers are getting a lot more price sensitive. When you look at this particular landscape right now, who do you think is best positioned in that way? Who's got kind of the sweet spot where you think consumers are looking to and willing to shell out money, even as these companies are able to juggle some of the costs that are still pretty elevated?
It's an interesting question. You know, as we look back a couple quarters ago, we were saying that the operators that would be best positioned to navigate this kind of environment would be those that offered value-oriented fare. You start to think about the cheapest cost to feed a family of four, for example, some of the pizza players, or with McDonald's somewhat disruptive value menu offerings. We've seen a lot more incidents of barbell pricing, where you've got the value-driven fare like Wendy's Biggie Bag on the bottom end of the scale, and some of the more premium products to attract a clientele that's feeling a little bit less pressure. So in this sort of environment, we like restaurants that have sort of compelling value offerings. We like restaurants that have scale-driven cost advantages. You think about a McDonald's or Yum Brands that's able to generate a lot more leverage over suppliers upstream and over independent software providers. And so they're able to offer the same food at a lower cost with equal or better margin. And with the way the consumer's feeling today, that positions those firms particularly well.
Sean, we've seen Wendy's and some of its competitors also push a little bit further, or push into late night offerings. It certainly seems like Wendy's is seeing early success within this offering. How do you see that, or how big of a build could Wendy's potentially see in this offering here in the coming quarters, and how quickly?
Yeah, I wouldn't necessarily expect it to move the comp materially. I mean, we're talking about a couple points of comp as you think about where the day parts break down. But the big news, I think, to take away from this is we're now at a point where the industry is only about 2% below pre-COVID staffing levels. We're starting to see wage inflation decline sort of into the mid-single-digit range and declining month to month to month. So the hope is that this is reflective of an environment where restaurant margins are going to be pressured a little bit less, even as we start to see top line slow. And obviously, commodity prices were a boost in the quarter, and for most restaurants will continue to be over the balance of the year, with maybe the notable exception of beef and potentially wheat.
Beyond the U.S., when you look at some of the international markets for Wendy's, how do you see that faring in this environment? How big of a driver do you think it can continue to be?
Yeah, a lot of markets outside the U.S., so it's very market by market. But it was interesting to see them ink the development agreement with Flynn. Obviously, they agreed to open up 200 new restaurants by 2034, which is relatively modest as you consider development agreements. But it is Flynn. Flynn is the largest franchisee in the United States. So it's interesting to see them push abroad with Australia. They also acquired 260 Pizza Hut stores, which they operate a large U.S. footprint of. With a lot of these international markets with Wendy's, it's challenging because Burger King and McDonald's already have substantial international footprints. That's true in Australia. And in most markets that tend to be smaller than the US food service market, there's not necessarily room for three players within one category like QSR burgers. So we struggle to see tons of upside in some of those smaller markets, like maybe in Australia or Germany or France.
Sean Dunlop, good to talk to you today. I appreciate the insight.
Disney out with a beat on earnings and a narrower than expected streaming loss, but revenue missed expectations and streaming subscriber numbers fell short. That's pressuring the stock in after hours trading. We're looking at a loss of just about 1%. For a deeper dive, we want to bring in Geetha Ranganathan, Bloomberg Intelligence senior media analyst. Geetha, it's good to see you here. So some good news and bad news in this report, at least from the looks of it right now. Some concerns about subscriber numbers missing expectations, revenue coming up a bit short. That's dominating the trading action here in after hours. But what's your first take at these results?
Yeah, so my very first take was, of course, at that streaming loss number, which actually came in much better than expected. We were expecting about $750 to $770 million in streaming losses. They came in substantially lower at about 550 million. That's one thing. Of course, as you pointed out, the streaming subscriber miss, at first glance, yes, it does seem like a huge miss. But then if you just dig a little bit deeper, most of those subscriber misses, actually 12.5 million subscriber losses, were at the Indian division of Hotstar. And remember, this is because, Disney actually has foregone a key piece of content, which is the Indian Premier League cricketing rights. Those rights, Disney kind of gave up on, just in a focus on being, kind of more cost conscious and cost disciplined. So we kind of expected this, and it's not really a big, it's not a big contributor to revenue, because if you look at a Hotstar subscriber, they bring in roughly about 50 to 60 cents per month versus a Disney Plus subscriber here in the US who brings in over $7. So it's not, the subscriber miss, the optics of it looks bad, but it doesn't necessarily really affect the profitability or the revenue line all that much.
Geetha, this is a company that is clearly very much in transition when you think about what it's trying to do with some of its more legacy parts of the business versus investing in streaming and other parts of the business where they see the future. Looking at where the company came in, they reported a $2.6 billion one-time charge in impairments. That was part of the number that dragged things down. Where do you think the company is in this transition, in this restructuring? What do these numbers tell you?
That's a great question. So I think that is really about trading some short-term pain for longer-term gains. So the narrative, at least in the streaming world right now, has shifted away from subscriber growth or just chasing subscribers for the sake of chasing them to more on profitability and being able to get to good end unit economics, making sure that the streaming business is a consistent long-term earnings growth driver. And I think Disney is doing exactly that. So that one-time charge, yes, it did depress earnings in this quarter, but what it does is it sets up the company for a much leaner and a cleaner kind of content cost profile. So remember, Disney is one of the largest spenders of content in the media landscape. They spend about $31 billion. A lot of that, of course, is sports rights, which is paid out by ESPN. But then you have a lot of entertainment content as well, whether it's films, whether it's, a new Marvel series or Pixar animation films. So all of this, and Disney is really kind of trying to right size the cost base to make sure that they can ensure hitting those profitability targets sooner than expected. So they had actually guided to getting to profitability in the streaming business by the end of fiscal 2024. We'll have to wait and watch and see if management says that they can accelerate that timeline, get there a little bit sooner. That should be something that investors can cheer about.
Geetha, what do you think about Iger's vision, his broader vision for ESPN? We had the news yesterday about Disney teaming up with Penn Entertainment going into sports betting, something that many analysts had expected now for quite some time. But does this signal anything broader just about what the future could look like for ESPN?
think the one thing that it definitely does tell us is that there is still a lot of value in the ESPN brand name. I think that is, a question that some of the investors were kind of asking, is there really value in ESPN? Does it have, the name recognition, the brand recognition? And absolutely, yes, it does. The fact that they're now able to get, $2 billion over 10 years without necessarily getting directly involved in the sports betting business, obviously, I think is low risk, high reward for, Bob Iger. So kudos to him for getting that deal done. And it really helps them now kind of monetize younger audiences, right? It's not just about reach, it's about kind of being able to monetize that. And they're going to be able to do that now. Does it say anything about whether they're going to spin out or sell the company? I'm not sure as yet. ESPN is still a very critical brand. It's still a very, very critical property to Disney. Of course, all options are on the table, as Bob Iger has said repeatedly. But having said that, you have to remember ESPN is also important to the company from a bottom line perspective. Yes, it is under pressure because of cord cutting, but it does still bring in about $3.5 to $4 billion in EBITDA every year. And now you have this additional revenue, of course, from the Penn deal as well.
Finally, we've been talking a lot about what that content pipeline looks like for so many studios, given just how long the WGA strike has been going on, and now you've got SAG-AFTRA on top of that as well. Bob Iger has said, at least publicly, he doesn't think these demands are realistic. How big of an impact is this having on the company? I mean, how do we kind of bottom line it? Because we keep hearing the pipeline is still there. It's a matter of how long this goes on. What do you see?
That's a perfect point. And ironically what we're seeing is the strikes are actually helping the bottom lines of these companies. I mean, we've seen this across the board from a Paramount to Warner Brothers Discovery, and today we saw lower streaming losses for Disney as well. So it's fewer content costs, so obviously better profit profile, something that the street is extremely focused on. So in the short term, it's actually helping them, ironically, but in the long term, that's when it's going to become a real problem, because content is the lifeblood of all of these media companies, most notably Disney. They have all of their key franchises, which are critical to driving new subscriber gains, which are critical to driving revenue and ultimately profits. So the sooner these strikes get resolved, obviously it is better for the industry as a whole.
Geeta Ranganathan, Bloomberg Intelligence Senior Media Analyst. Good to talk to you today. Appreciate you stopping by.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Speaking of wild years, Disney, the latest streaming service to hike prices and crack down on password sharing. The media giant shifting focus to capitalize on existing subscribers, with CEO Bob Iger telling analysts on the earnings call that the company is aiming to migrate more subscribers to its ad-supported option. For more details on the call, we're joined by Yahoo Finance's Alexander Now. Ali, what stood out to you from the call?
There were quite a few things that stood out. I think number one being the fact that we are going to see price hikes again for the second time in a year. And I think for most consumers, they're thinking to themselves, what the heck? We now have all these streaming services and they're getting more expensive. And these price hikes are pretty significant. The price of Disney Plus, that's going to go up by 27% to $13.99 a month in the US. That's up from the prior $10.99. And remember, when Disney Plus first launched in 2019, that price was $6.99. So now we're pretty much double from those levels. Hulu, meanwhile, those prices are going to increase by 20% or $3. So, this is coming as Disney is trying to pare down some of those losses, especially those streaming losses, and increase those profitability levels. That did happen in the quarter. Disney reported streaming losses totaled $512 million in Q3. That's about half of the $1.1 billion loss that was reported in the prior year period. And that was also significantly ahead of estimates. So a positive thing there, but probably a negative for consumers is the fact that we will be seeing a Netflix-style crackdown on password sharing. So to me, this is a sign of what's to come from all the streaming giants. Bob Iger did talk about this a bit on the call. Here's more of what he had to say.
We are actively exploring ways to address account sharing and the best options for paying subscribers to share their accounts with friends and family. Later this year, we will begin to update our subscriber agreements with additional terms on our sharing policies, and we will roll out tactics to drive monetization sometime in 2024.
So 2024, the password sharing crackdown coming to Disney Plus users. And then another key thing I want to mention is the parks business. Bob Iger did say that there's been some softness when it comes to Disney World in Florida. And that's due to a few things. One, the fact that we've seen tourism slow. We've also seen a strong US dollar that has discouraged travel from international guests. In addition to the fact that we've seen a decline post-pandemic when it comes to that pent-up demand. So not as much demand as there used to be. That being said, though, we did see the parks, experiences, and products segment surpass revenue expectations in the quarter. Operating income also came in strong, $2.43 billion. That's ahead of estimates and also ahead of what we saw in the prior year period. International parks, a large part of that story. And then finally, when it comes to ESPN, we didn't get too many details on that, but we do know that Bob Iger is super committed to bringing ESPN fully over the top as a direct-to-consumer streaming service. He talked a little bit about that Penn Entertainment partnership, about how Penn was very aggressive in their approach, and that's why they went with them. So we'll see what's to come from that.
All right, so got to know your vibe check from this call.
I would say the vibe check is fine. It's fine. I think from an investor perspective, we've seen shares go up. I do think it's encouraging that we have losses going down, and they do seem adaptable, right? Disney seems not to be so tied to what they said they were going to do, like sports betting, for example. Now they're embracing that, so they're willing to pivot in the name of profitability and in the name of paring down those losses. I do wish we got a bit more color and a bit more detail on ESPN, possibly some of those strategic partnerships. Bob Iger, he didn't spill his guts like we've seen him do in recent interviews. So I wanted a bit spicier of a call, but overall we did get.
Name me the last spicy earnings call you guys heard besides Tesla. Tesla x Tesla.
Spicy?
Yeah.
That's true.
And for we also have vibe check the shares, right? The shares are up 2.3%, which I think also is
contributes
fine.
Yes, which is fine. So
last quarter.
That's my take.
Yeah, that was spicy.
That was spicy.
Yeah, it had spice.
The news was spicy.
Had seasoning.
Okay, all right, fair enough. All right, Ali, thanks.
We're gonna come back and rate the spiciest earnings calls.
I'm just trying to manage your expectations,
That's true.
guys.
I know.
That's all. Thanks so much, Ali. Really appreciate all your coverage of Disney and doing double duty on CPI today. Yeah. Also, if you look at YahooFinance.com. Yes, exactly.
Disney reported mixed results for its third quarter after the bell on Wednesday, missing expectations for revenue but beating on earnings per share. Disney stock higher today after initially dipping in after-hours trading. Joining us now, we've got Matthew Thornton, who is the Truist Securities Analyst. Matthew, great to have you here with us this morning. How should investors look at Disney stock after this report?
Look, I think we got some positive incremental takeaways here. I mean, the focus for this company right now is clearly profit and cash flow over revenue and subscriber growth, at least for the short term. And if you look at what we got yesterday in the streaming business, profit was better, particularly on pricing. Subs were weaker, but I think that should be and probably was expected. The linear TV business continues to struggle from a secular perspective, but again, I don't think that's new. The box office remains challenging and lumpy. Again, I don't think that's new. And in the parks businesses, look, I think you've got some puts and takes. International strong, domestic softening from really, really tough comparisons year over year. But I think the probably more important incrementals here are, the company talked about raising price in the streaming business probably a little more aggressively than folks expected. They talked about cracking down on password sharing, very similar to what Netflix has done. They introduced a new sports betting partnership yesterday, and they said that their cost actions are actually running ahead of plan. So they're going to do better than that $5.5 billion. So I think if you kind of wrap that all up, profit numbers are probably stable to maybe even rising coming out of this earnings results.
I want to focus in, Matthew, it's Julie here, on the streaming business in particular. And you mentioned that they're sort of following the heels of Netflix here in terms of talking about password sharing crackdown, although it sounds like they haven't done it quite yet, raising pricing, offering more tiers. It sort of feels like after Netflix lost its mojo, it feels like it's gotten it back and then some. And that now there's sort of an also-ran situation where the other streamers are maybe running to catch up with Netflix at this point. Is that your impression, and are they going to be able to catch up?
I think it's a maturation of the streaming market. I think we've had the last 4 or 5 years of pure focus on subscriber growth and gaining scale, and I think we are now getting to a point where penetration rates are higher, where there's a much more balanced approach to monetization and profitability. And so I think a lot of these services, Disney included, are really thinking through what are the right price points, what is the right tiering structure, how do we lay in advertising in an accretive way, because subscriber growth isn't going to be at the levels that we've seen in prior years because the law of large numbers are starting to set in here. So I think it's a very natural maturation process across the streaming landscape.
And so this is still a company as well that has a lot of kind of changeover that's taking place at this time, either in strategy that's enacted or just in terms of what the experience for a myriad of consumers that they deal with looks like as well. But what's caught investors' attention is whether or not there could be parts of this company that are eventually sold off. Do you see that coming to fruition? Is there anything that you heard on the call that gives you the inclination to believe that we could be looking at a far different Disney or part of a Disney that gets sold off to some other company over the next, say, 12 months to 18 months?
I think what's pretty clear is there's a lot of optionality, and I think CEO Bob Iger made that point pretty clear. If you look at kind of what the core is of this company, it really is their tried and true owned and operated brands. So the Disney brands, the Marvel brands, the Star Wars brands, the Pixar brands, which of course extend to their portfolio of parks and cruises and experiences. That is the core of this company. That is the growth driver. That is the highest margin, highest value piece of this company. I think where the optionality really lies is around their linear networks business and, of course, ESPN and the sports ecosystem. I think they were pretty clear of that within ESPN. They are preparing for a transition to a streaming world. They are looking at strategic partners that can help them on the content or distribution side. And so what I think that tells you is they are hard at work, pen and paper, trying to figure out where they want to take this business. And it could look very different. And when you think about the legacy networks business, so if you think about ABC and FX and some of the linear channels, I think, again, all cards are on the table here, and that could include a sale or spinoff of those assets. So I think the point here, we don't want to get over our skis, but the point here is there's a lot of optionality, a lot of work being done, a lot of conversations being had.
Matthew, bottom line, I know you're buying the stock, but given what we heard specifically from the company on the call and in the report, would you be buying that stock today on what you heard?
Look, I think the setup here for the stock is better today than it was yesterday. And then the reason I say that is, again, I think the results that we saw yesterday were better than feared. I think profit numbers are probably stable to going up coming out of this print. We have an investor day, a 3-day investor event that they'll host next month where we'll get more incremental color. And I think sentiment in general, could swing in a couple different areas. If you think about the ongoing strikes, I think sentiment is clearly, pinned negative there. If you think about box office choppiness, those are things that can go back the other way pretty quickly. So we actually think the setup today is better than it was 24 hours ago.
And then just one quick final question on the parks, and specifically on Disney World in Florida. What's going on there? Like, what's really going on there? And are we going to see a rebound in the traffic there?
I think it's a combination of several things. I think you've got really tough comparables. Remember, they had their 50th anniversary promotions and events last year. You're starting to anniversary those. I think, when you think about 2022 into 2023, I think there was a lot of catch-up vacationing because of what happened during the pandemic, and that's starting to moderate and normalize here. And so I think it's a law of large numbers and a lot of normalizing of demand and tough comparables that you're seeing in Walt Disney World. I think conversely, if you look at perhaps Disneyland, but certainly more so international parks where the pandemic's extended a little bit longer, so we're still much earlier in that catch-up phase. Those are still outperforming and exceeding expectations. Cruise lines are another great example there. So I think they're in different parts of the curve, getting back to kind of a normalization.
Here's where we're at. When we saw real hyperinflation last year, we took aggressive action, as most food companies did, to protect our margins. We have not had passed on a price increase to our customers since about July of last year. So our team's done a nice job of holding that. We're going to be lapping all of those prices. We want to meet consumers where they are in the back half. And we believe we're in a good position as we lap all of the prices, try to hold it steady, deliver value to our consumers in the back half, and see volume recover as we do things like family packs that provide more value to consumers, and use our productivity initiatives to hold pricings where they are. So it's certainly coming out of a spot. Our consumers are certainly feeling the punch, but we believe we're focused on that. We're focused on delivering that value to our customers, ultimately to our consumers, and expect to see that volume recover as our price impact inflation to the customer really goes to back down to normal levels.
Andy, it's Brian here. Always great to get some time with you. I'm going to refrain from asking you if you've seen a pickup in your convenience store business with all these big lottery jackpots, but I will ask you this. Have you seen any impact to the convenience store business lately as gas prices have been back on the rise this summer?
It's a summer season, so we do see traffic more recently, with the rise of fuel, that sometimes has an impact on our consumers' behavior. And a lot of times it increased the frequency to the store because they're not filling up the tank every single time. What we're seeing right now is a slight increase of traffic. We're about flat year on year. That was slightly down in Q2. We expect it to continue to rise, and we're well positioned for that business. Brian, as you know, we have a terrific C-store business. Scott and the team do a great job. We have availability that's about 20 to 25 points greater than our next closest competitor. We're bringing them innovation. So I feel like we're in a good spot for convenience, but certainly we watch those fuel prices very, very tightly.
Something that we've been keeping a close eye on within the consumer price index readings that we get monthly is this food at home figure. And that increased by about 0.3% over the month here. And the reason that we're keeping an eye on that is because that directly correlates as well to your business. If people are going through one less aisle and saying to themselves, you know what, I need to cut back on that particular part of my grocery experience. How do you make sure that you're retaining that customer? And is there any pickup in those grocery aisles among some of the newer products that you've introduced into the stores?
Yeah, a couple of questions there. The first is we partner with our customers to really, throughout the store. We have many points of interruption throughout the store. It's not just the aisle. You are right about the number of units in the basket to offset the price, but we're in a very accessible snack. And as I said before, we try to give our customers the right value. We feel like we're set it back to school. We sharpen value where we think we can. We launch value family packs, which are doing very well, which allow consumers to really participate in larger sizes, but a better value. So we do all of that and partner with our customers in a very good way to be able to take advantage of that. Related to our new items, they are really doing well. And that's one of the reasons why protecting our margins, but doing it not just through price, but through productivity, which our team's been able to do, is really important. It allows us to bring what consumers want. Our new Casbars offering is really off to a terrific start. It's a reimagined baked goods in a bar form that expands the consideration set into the $65 billion snacking universe for all of our consumers, and gives them really the quality of baked goods they expect for Hostess, but the indulgence of a bar and layers that they want. So these things like family packs and old-fashioned donuts and our zero sugar Bortman cookies are all ideas that we're able to bring to consumers because of our productivity initiatives. And that's what consumers are looking for in indulgent snacks.
Andy, earlier on today, I caught up with Campbell Soup CEO Mark Klaus, and I see a lot of similarities between how he leads, how you have led. I see similarities in the businesses. You have both led turnarounds of these storied brands. He just made a big acquisition. I mean, do you think there's a deal to be had out there over the next few months as we might start to see a pickup in consumer packaged food? Is there a new category you want to get in? In Mark's case, he's expanding into higher priced pasta sauce.
Yeah, Mark's a terrific leader. I've known him for over 25 years, despite being a West Point guy and I'm an Annapolis guy. He's a terrific leader, so I'm not surprised his success. He's leading Campbell's too. But very similarly, we look at the M&A landscape, and our frame of reference is around snacking and indulgent snacking. And we have built over the last several years capabilities, whether it's consumer insights, marketing and innovation, our supply chain, to be able to take advantage of this growing $65 billion landscape. And we see that M&A and some of these businesses that are maturing are at the right spot that may have been interrupted by COVID, really moving into that space in a really nice way. So it's always part of our calculus. Our number one place for capital is our core business, and number two is M&A. And our team's doing a really nice job of doing that. We're coming out of building out our Arkadelphia bakery, which expands capacity we need. And our next priority is M&A. We think we're in a really good job for that. And if not, our organic growth and our long-term algorithm will create great shareholder value.
Well, the Traeger Grill's CEO once told us that Americans love grilling. And Andy, you've made a good case for Americans loving snacks today. Hostess brand CEO Andy Callahan and Yahoo Finance's executive editor Brian Sozzi. Thanks so much for the time.
We want to zero a little bit more in here on that question of whether Disney could be a buyout target. It's a big question coming out of the media giant's third quarter earnings. You apparently shouldn't ask CEO Bob Iger specifically about it. Here's what he had to say when asked on last night's earnings call.
On the theme of considering options for Disney, there was an article published recently that speculated that the entire company could be sold.
I just am not going to speculate about the potential for Disney to be acquired by any company, whether they're a technology company or not. Obviously, anyone who wanted to speculate about such things would have to immediately consider the global regulatory environment. And I'll say no more than that. It's not something that we obsess about.
Iger may not be obsessing over it, but some analysts probably are. Joining us now, Robbie Whalen, Wall Street Journal reporter who covers Disney. Robbie, maybe they're not selling the whole company, but there is still the question of parts of the company, what will be sold. And I think that's still very much on investors' minds. What are you hearing from inside the company and from investors and analysts about that question?
About the sale of assets, you mean?
Yes.
I'm hearing that Bob Iger is very anxious to reduce his exposure to the linear TV business, which not only is dying a fairly quick, painful death, but it also is something that he's been talking about for over a year. I mean, he has his famous quote from when he was not in the CEO's chair last year, where he said that linear TV is headed for a precipice, and we don't know. It's not a matter of if, but when this business stops being profitable. A lot of people think that once we hit 50 million U.S. households with access to cable packages, either through traditional cable or these digital services that bundle cable channels, that's sort of a psychological barrier, and there's a lot of people who are kind of going to drop out of the business at that point because it's going to be much harder to make money. But yeah, I mean, he clearly wants to sell whatever value there is left in that business. He's made it pretty clear there's a for sale sign on that. And he's looking for partners in ESPN. From what I've heard from folks who speak to Iger is basically that he wants to reduce exposure on linear very badly. He wants to get that done as soon as possible because it's a big albatross on the company's stock price. But also that he feels very strongly that ESPN needs to continue to be part of Disney going forward. And to the extent there have been rumors that ESPN might be spun off or is on the block itself, I've heard those rumors kind of diminish by people who know what's going on.
Interesting. So, if indeed, as you're talking about, he's been wanting to somehow exit or reduce exposure to the linear business, why hasn't, ESPN aside, is it tough to find buyers for this stuff right now because nobody wants exposure or more exposure to this business?
There's some thinking that TV networks like that could sort of go the way of newspapers, the way they've gone in the last few years, which is to say that there might be buyout firm interest from them. Certainly there's interest at a fire sale price in them. But I mean, don't forget that these networks and this business itself, for Disney at least, still throws off about $1.8 million, $1.9 million a quarter in operating income. So it's not like they're actually losing money on this business. It's just that there's been this inflection point we've reached at Disney at least, which is that businesses like the parks are really a lot more reliable at this point than linear TV. For years and years, linear TV is what subsidized every experiment that Disney wanted to try. It's certainly what subsidized the push into streaming and sort of the all-out push that they made at the very beginning, where they were focused entirely on growth and on attracting new subscribers and basically giving it away for free to a certain extent. That was all paid for by these advertising fees and subscription fees that the linear TV business generated. They're just not coming in as consistently anymore, not by a long shot.
Robbie, what's clear here too is that there have been two very different types of eras that Bob Iger has had to govern Disney through. And previously it was the one where they were acquiring some of the major kind of content producers and then also making specific deals in order to make sure that they could grow out their business and kind of engage with a larger fan base. And now in this one, it seems like we're watching kind of an executional strategy where trimming some of the costs, some of the fat, trying to figure out exactly where that next wave of growth or leg of growth is going to come from, and ultimately what the succession plan looks like at Disney. But for right now, with Bob Iger over top of the company still, what is the defining type of narrative that kind of annexes itself to his leadership right now through this era?
Well, yeah, it's a really strange thing to see in a lot of ways. Bob Iger as seller, and as you noted, for most of his career and for most of his time leading Disney, his legacy and his the imprimatur that he's put on the company has been to acquire. He's bought Pixar, he's bought Marvel, Lucasfilm, and then of course the 2019 deal to buy most of the entertainment assets of Fox. That was a $72 billion deal. This is a guy who's made being acquisitive his signature for the Walt Disney Company. And he's had great success. He's grown the company from, something like 40 billion market cap to, at one point it was around 270 billion market cap. I mean, the growth has just been phenomenal, and that's why he has the reputation that he has. So looking at him and seeing him saying, our new MO is we're going to sell in order to right the ship and to stabilize the company for the future is jarring for a lot of people. And I think it's actually jarring even for him. I think if he had his druthers, he would be out there thinking about what's the next company, the next library of IP that he can acquire to sort of lead the company into the future. And to be clear, there is one acquisition that he's looking at, which is buying the rest of Hulu from Comcast. I mean, Disney's going to be locked in a negotiation with Comcast over the next year, likely, to sort of figure out what the right price is for the rest of Hulu. But I think it's very uncomfortable, and I think it's going to be really interesting to watch how that plays out on succession. Because if you're a guy whose core competency is growing and acquiring and expanding a company, a beloved American brand, into other areas and other storylines, other types of content, when that's what he loves to do, if what he's being forced to do is instead to sell off key assets, including ABC, where he essentially grew up as an executive, you can see how that might wear on somebody and how it might not seem like he's having a ton of fun, because that's what he has to do. He's making these tough, painful decisions.
Well, Robbie, he doesn't have to do the job forever, as we well know. And as you've covered, succession is the other big sort of question hanging over the company. Just quickly here, a little confusing that he's brought in Tom Staggs and Kevin Mayer as sort of advisors now. But what's the latest we need to know about succession?
Yeah, that sort of set off the rumor mill running in a reasonable way, I think. I mean, so Tom Staggs, former CFO, former Parks head, a lot of experience in operations. Kevin Mayer is more of a deals guy, but he was definitely Bob Iger's right hand on deal making and growth when he was at the company. And the really curious thing here is that those guys now have moved on pretty fully. They're investing a few $1 billion for Blackstone in their own company, Candle Media, acquiring some brands like Reese Witherspoon's Hello Sunshine, Coco Melon, a lot of brands that might be of interest to Disney. But I have a hard time seeing Disney. In other words, Disney would have to buy them out most likely in order to bring them back if wanted one of those two guys to become the next CEO of Disney. And it's sort of every day that goes by, it sort of has felt less likely that might happen, just given the financial shape that Disney's in. I mean, you have to buy out a very big company in order to sort of pry away its leaders. And then secondly, Iger, you have to keep in mind, these two guys are guys who Iger passed over before. He elevated them to roles that really seemed like they were being groomed to be the next successor of the company. And he decided, no, I'm going to go somebody else. He went with Bob Chapek. And so it's very curious to see them back in the fold, even in advisory roles. But it's definitely set the rumor mill running. I think on succession, look, the guy just signed a 2-year extension on his contract. He'll be here ostensibly until 2026. We know that they're looking at people, but I just don't think they're there yet. I mean, I don't think I think he really wants to do this right this time, and right means find somebody who can execute on his strategy and carry the company into the next era, so to speak, competently. And he wants to avoid what he views as kind of a nightmare with the last time he did this. And I don't think we're that close to having an answer on that yet.
Yeah, well, hopefully he won't wait until, right before his contract is up. Robbie Whalen, thank you so much for your perspective on this. So the Wall Street Journal reporter who covers Disney, appreciate it.